Clint Templeton joins us now. Ajay, nice to have you back. Thank you for joining us. Let's first understand your market view, risk versus reward. What is your market view?
Yeah, good morning, Niju. Thanks for having me. As far as the markets are concerned, I think there has been a bit of a reality check after the latest quarterly results. So we have seen the quarterly results of the first two quarter were also quite tepid, but people had hopes because the elections were there and the companies were talking about the pickup in the second half. But even in the December quarter, there has been some improvement, but nothing much. So basically, if you look at BSE 500 or NSE 500, that is the 500 large companies in the country, the top line growth and EBITDA growth would be in the range of 5 to 7%. So not much of a pickup. So basically, the earnings downgrades continue, and FY25 the earnings growth for Nifty at least are in the range of 8 to 9% now. So in light of that, the valuations which we are trading, and especially, and I'm sure so many people would have talked about the mid-cap valuations. The mid-cap valuations were on the higher side. So there had to be a reality check, and that reality check came when the results came. This time, the reactions were not so benign, as in if the results were not good, the reactions were quite drastic on the negative side. So that's what is happening. I think the markets are in a cautious mode. The markets want that the companies deliver the growth. So as we stand now we are expecting earnings growth of around 14% for FY26. So the market is looking for direction there. If the earnings growth comes, then the markets will stabilize. Otherwise, we might have more volatility going forward.
So Ajay, clearly seems we're now out of the woods. Have the markets priced all the gloom and doom though or not?
Yeah, so markets have definitely priced part of the gloom and doom. Whether everything is done or not depends on the growth, as I was mentioning. But definitely there are pockets and opportunities now open up. And I think even you guys were talking about how things in the large cap are looking much better. So we had kind of anticipated that in our diversified funds like the Focus Fund. We had put our larger weights towards the large caps. So we have 75 to 80% in the large caps. So we are seeing a lot of opportunities in the large cap space. In the mid and the small cap space, also there are opportunities, but the opportunities are much fewer. Therefore, we are still looking for better entry points there. But it's a dynamic process, and if, as we know, if the market's correct, then some of the stocks correct a bit more, and when that happens, there might be some opportunities which might be opening up. So it's a continuous process, and that's what we continuously look out every day for the opportunities.
Follow-up question. Markets are down because earnings are down, economy is down. If earnings come down, or if economy is slowing down, the first sector to slow down will be financials. But across the board, including your funds, every fund manager is bullish on financials. If the outlook of economy and world is slightly dim, then why should one buy into financials? Because that's a leverage play.
Yeah, that's true, but the leverage has not worked in the last 2, 3 years on the upside. So the expectation is that the leverage will not work on the downside as well. So by that, what I mean is that the growth slowdown, which has happened across the sectors, is kind of much lesser in the financials. So if you look in the last few quarters, when the top line growth or the earnings growth for a lot of sectors have come down by 10 or 15%. For the financials, the growth has come down just by 1 or 2%. They were growing at 14, 15%. Now they are growing at 12 to 13%. But the other attractive part about the financials is the valuations. It is the only sector where the valuations are lower than the last 5 or 10 year averages. Whereas most of the other sectors, even after the correction, they are trading at valuation which is much higher than 5 years and in some cases even 10 year averages. And if you look at the financial sector, the other issue about the asset quality, in our opinion, is some time away because we have already seen some pockets of asset quality deterioration in microfinance and unsecured personal loans and credit cards. Part of it that is already played out, but that itself is like 10 to 15% of the entire banking sector, and we don't see a kind of systemic deterioration in asset quality, especially because on the corporate side there has been no lending binge in the last whatever 4 or 5 years, which has typically been the case in the previous asset quality deterioration cycles. So we are pretty comfortable on the asset quality side as well. On the other issue about the margins also we don't see much of an issue as long as the rate cuts are not very fast, and we don't see that happening in India because it's not happening in the US, and our interest rate differentials with the US is not very high, so we don't have that kind of a leeway to have a higher rate cut or a faster rate cut. So putting all this together, we think that the financials are the best pocket in terms of the sector, and within that, the private sector banks are much better placed.
That almost seems like a consensus view, Ajay. But I think, the question is exactly that. The uncertainty around tariffs and how it's going to play out for sectors like IT, pharma, metals, etc. Do you think it's best to steer clear from globally linked sectors or tariff sensitive sectors, if you will?
Yeah, so it's we can't have that black and white view, so you have to have more nuanced view. So the thing is, we need to figure out whether we have the global competitiveness, even if some tariffs are built in. So first of all, if you talk about the IT sector, I don't think at the moment there is any thought process of any tariffs on these services. Of course, it can happen in the future, but right now that is not on the anvil. But as you have been discussing even before the show, how there are other challenges in the IT sector, and that remains. So it's not only the tariffs, you have to look at the other things. If you look at the pharma sector, India is a very strong contributor to the lowering of the costs in the US pharma space through the generics revolution, which has happened over the last 20, 30 years. And that has contributed to lowering of the costs for the US healthcare sector. And as we know, the costs are quite bloated in that. And so, in that sense, there may not be much impact or much thought of any tariffs on that front. Whereas you look at the other sectors, definitely there will be some impact, and the companies would need to adjust. And that is why we are trying to focus on companies where the impact is less, and where actually the drivers would not be what the tariff is making an impact, but whereas the normal business growth, if they are able to participate in that. So it's again, as I said, a continuous process, and especially because things are very dynamic. The US administration is making statements and then sometimes not following on that. So we need to see actually what the action is rather than what the talk is. So we are focused on the action, and as the action happens, then we might have to do the reaction. So in that sense, we have to be a bit more flexible and not being rigid on making very strong views, especially as far as the impact of the tariffs from the US are concerned.
So what could be the turn moment for market? Could it be just time? You have to just wait it out. This year will be a tough year. Nothing happens, but then after 6 months, suddenly markets will look attractive. Earnings would kick in. I mean, do you think this market will have to just grind itself? वो कहते हैं ना, समय बड़ा बलवान होता है, right? Time shall heal everything.
Yeah. So that's one way of doing it. Yes. So that's what you're referring to is the time correction. And I mean, if you look at Nifty, for example, we might be 5 or 10% above the last 10-year averages or the 5-year averages in terms of valuations. So in that sense, only that kind of correction is required. And if there is a 15% growth, then yes, we are talking about 6 to 9 months of time correction if the actual correction does not happen. Whereas in the mid caps, it might be a bit more. Small caps also, there might be some higher correction compared to the larger caps. So the higher correction could mean a higher waiting period. But on the other hand, there could be some pickup in consumption because we are kind of seeing a subtle shift of the market driver from the investments to the consumption. The fillip has come from the budget, where the tax cuts would benefit the middle classes and the upper middle classes, and that could be contributing to consumption, especially in the consumer discretionary area, whether it is refrigerators, washing machines, automobiles, that kind of thing. So some pickup in consumption can happen. Next year, we are also kind of looking forward to the Finance Commission settlement, and typically when that settlements happen, we get the arrears for the last few years. So that could also be another leg up for the consumption. So there could be some pickup of the growth coming from the consumption side, which could lend some buoyancy in the market. So these are the two ways where the markets can improve.
Ajay, also talk to us about the newish tech themes, because of late in the recent correction, all these stocks have also participated. Share your take on this one. Given the correction and the fall, do you find the valuations decently placed in? What's your overall outlook? Are you looking to increase your exposure here?
So in some of these pockets, we had some decent exposure. So if you look at the internet tech companies, the new age tech companies, we had some exposure there. And of course, when the risk off is there, and then people start charging a decent premium for the longer term cash flows, there was bound to be a correction, which would be a bit more than the markets. But then these kind of plays, we are looking for longer term, because the actual value creation comes from the longer term when these companies are able to grow at a very fast pace, and then get into profitability, and then the profitability ramps up. So it's a longer term game. And of course, in between, in the last 1 or 2 years, some of them we saw a good bounce back, because earlier they were having a distress valuation, and then they kind of came to the normal valuations, and in the euphoria, definitely they kind of moved towards a valuation which was a bit on the higher side as well. So some that amount of correction has happened. But as I said, since we already have the position, we are kind of maintaining those positions. And of course, we continuously reevaluate our assumptions on these kind of companies, whether the actual is in line with the assumptions which we have been making. And in some cases, the actuals have not delivered in line with the assumptions which we are making. And in those cases, we have made some portfolio actions. And in the cases where the assumptions are fine, and there is a bit of a market correction there is a bit of a correction in line with the market correction, then we are comfortable holding on to it, because we are looking for a longer investment horizon, and we are looking for compounding. So these kind of stocks are growth compounders, and we are comfortable holding them.
There is this whole view that small and mid cap stocks have gone in for a long winter. Sell out, get out, cut out, and move to cash or move to large cap. Is there merit in thinking like this?
So it depends. Very difficult to have a general answer, but if you're asking a personal opinion, I have seen in my last 30 years, it is very difficult to kind of time the market, especially on both the sides, that as you're mentioning, you sell out, and you get that time right. And then when you're getting in, you get that time right as well. If you're referring to SIPs, for example, I don't think it makes sense to get out of the SIPs for the mid and the small caps also, because SIPs, the entire concept is you kind of keep putting in when the market correction is there. So it does not make sense, in my personal opinion, to kind of get out of the SIPs itself. So the point I'm trying to make is the old cliche that time in the market is more important than timing the market, because I don't think anyone can time the market consistently. That is get the buy and the sell points both right and on a consistent basis. If you're lucky, you might be right, but it's better to be having a disciplined approach than trying to be lucky.
No, but my point is perhaps coming from the fact that you know it more than anyone else that markets, they tend to follow a cycle. There was a time when mega cap does well. There is a time when small cap does well. There is a time when balanced advantage fund will do well. There is a time when, let's say, large caps will do well. So considering what the starting point of small and mid cap stocks is, and for somebody who has a 3-year time horizon, if large cap stocks have a potential to give better returns, and if small cap stocks and small cap funds have potential to give lower returns, then maybe it's time to flip. Because if starting valuations are, let's say, lower for large cap than small cap, on a 3-year basis, large cap will give better returns. That's my limited point.
Yeah, you're right theoretically, but as we have seen in the markets, the theories do not work in a very smooth fashion. So they ultimately work, but what we are talking about 3 years, it might happen in 2 years, it might happen in 5 years. So the actual may be slightly different from what the theory is. As we have seen in the last couple of years, I don't think most of the market participants expected the markets to do so well. So in that sense, we have kind of borrowed the returns from the future. So when that will happen, how that will happen is a bit difficult to predict. And therefore, it is always a good policy to not try to be too cute and try to time the market, because sometimes you may be right and you may be right actually, that might happen in the next 3 years. But on the other hand, there is no guarantee that that might be the case. It might happen within 2 years only. And or the other way is actually over the next 6 months or 12 months, for whatever reasons, the mid and the small caps might still outperform. But after that, they might underperform tremendously. So it looks good on paper, but when actual the ups and downs are happening, how we react and how our psychology is as an investor, that is the crux. So if you're trying to kind of remove the emotions from investing, then it's better to have a longer term view and not try to be up and down, because we have seen that in a lot of cases the fund returns are totally different from the returns which the investors have got. And the reason for that is because investors have been trying to time the market and they've not got it right most of the time. And that is the case globally. It is not the case even in India. So only from experience we can say this, but there is always something which can happen in certain period. But I would still say that it is very difficult to happen consistently.
Ajay, just also wanted to have your take on the industrials as well, because given the recent budget, what we have seen is that the government spending wasn't that exciting. And also given the recent move in all these industrial stocks, give us a sense that do you believe that the best is behind us for the industrials, or maybe there's some valuation comfort still left?
Yeah, so definitely we have seen that last year the industrials did very well, and that was on the back of good order flows and good execution, the margins also improving. So we are maybe kind of getting into the mature phase of the cycle or the late cycle in the industrials. And as you have rightly pointed out, the government capital expenditure has kind of slowed down, and that was bound to happen because they've done such a large growth in the last 4 or 5 years. On the other hand, the private sector capex has started happening, but it is not happening to that extent, because I think the main reason being the demand itself is kind of not to the extent which is required for the new capex cycle to start. So in that sense, we are seeing that there is a bit of a caution coming on the sector. And also, we had seen a lot of euphoria last year in some of the narrative stocks, the narratives, be it in some of the public sector names or some of the defense names. And again, as I was mentioning at the beginning of the show, that there has been a reality check. There has been a reality check here as well. We have seen a lot of news in the media how um, uh, some of the capital goods companies, especially in the defense or the public sector space, are not able to kind of deliver the growth which was expected in terms of the actual execution, because there are a lot of challenges, a lot of constraints, whether coming from the vendors or from their own capacity itself. So basically, the actual has been different from the expectation which you could have imputed from the stock prices when they kind of went flying up higher. And going forward also, the likelihood of growth being muted is much lower. So if you look at the focus fund itself, we used to be kind of 14-15% overweight in the whole industrial area, but now actually we are underweight. And the reason being that the growth kind of reality check is happening. And at the same time, the valuation, though they have corrected, they are still much higher than the last 5 or 10 year averages. So we are not still in the comfortable zone in terms of risk versus return profile. And that's the reason we have gone underweight in industrials in some of our funds.
All right, Ajay, with this, we let you go, and that really appreciate you taking the time out and speaking with us, and also telling us that where are you finding the opportunities at this point in time. But let's get back
Thank
to the
you.
markets then, and what a move and what a